Welcome to the Stockout. This is your show at FreightWaves for all things related to the consumer packaged goods, CPG industry. I am your host, Mike Bowden-Distel. I'm the head of Intermodal Solutions here at FreightWaves. In addition to following Intermodal, also do the consumer packaged goods newsletter and show. And so today, what I have to talk about is not so much the CPG companies themselves, but I'll talk about various things that are impact the CPG companies. I'll give a consumer update. I'll talk about the pending Kroger Albertsons deal. Always seems to be a lot to discuss with that deal. I'll talk a little bit about Costco's earnings, which has gotten to be one of the biggest grocery retailers. And I'll talk a little bit about this FreightWaves research report that just hit. I haven't had a chance to go through the whole thing yet, but I'll give a few highlights that really sort of stood out from flipping through it. And then if to the extent there's time, I'll talk about the hearing the next couple of days in Washington, D.C., where Union Pacific will no doubt be grilled by the Surface Transportation Board over its use of embargoes as a way to deal with congestion. I think there's going to be a lot of fireworks there. So no sponsor today, but we'll go right into it and start to talk about the macro update. And really sort of the big thing that came out today, I want to throw this chart on the screen, is the central bank survey of consumer expectations. And so this is just a survey of expectations for inflation. And I think it's good news that this is starting to come down. So the central bank survey this last month, 5.2% expectation over the next year, and that's the lowest it's been since August of 2021, and it was down 0.7 percentage points from October. Now, I don't know the people that are answering this know exactly where inflation is going, but I do think that it is a positive for consumer spending if consumers are less concerned about the ever-rising cost of everything. I think what's going into that is falling, gasoline prices. Maybe some are really following the commodities, closely and seeing that the agriculture commodities are coming down. But I think in general, or maybe the other thing that goes into this is the discounting at general merchandise that you're seeing at stores like Walmart, Home Depot, Target, those things. So I think of this as a positive. I don't buy into the academic argument that says if inflation is hot, your dollars buy more today than they will in the future, and therefore you should spend your money. I think in practicality, the more that inflation, you see inflation as being a risk, the more you're concerned about just affording the necessities. That causes you to pull back on spending on things that are not necessities. So I think any expectation that inflation is going down, a positive for consumer spending. There's also the producer price index came out in the last couple of days. I think it was data that came out, December 9th. That moved up 7.4% for the 12 months ending November and up 0.3% from October. And, that was better than it has been in most recent months. So that's the prices that producers pay for their, costs. And you sort of break that down into goods and services. Final demand services still up 0.4% from the previous month. Final demand goods up 0.1%. So that's good news for goods makers. Should start to see some improvement in margins, assuming that the consumer prices to consumer rise faster than that. But maybe the one exception that proves the rule is food, and food is still an area where you're seeing lots of inflation there, even though a lot of agriculture commodities have come way down. I'm going to read through a couple of these stats here. So the final demand for food in the producer price index up 3.3% from October and up 15.5% year over year. So still a lot of inflation there. That's pretty much tracking closely to what most CPG companies are passing through in terms of prices through the retail channel onto consumers. A lot of the CPG companies that have reported recently and talked about their pricing for the next year has been right around that 15% range. So not seeing a lot of pullback in food, sort of despite some of these agriculture costs, and I think that's related to inflation in labor, still higher transportation costs once fuel, diesel fuel is included. Cost of manufacturing is high, cost of packaging is high. All of those things still pressuring the food producers' costs. And so I think in balance, most of that macroeconomic data on the consumer is positive. But we'll move on to the next topic here, which is a judge denies Albertsons dividend request. So this, I think there's going to be a lot of things to discuss over the next, let's call it year or so, regarding the Kroger's pending acquisition of Albertsons. This would be the number one traditional grocery retailer, acquiring the second largest grocery retailer. Walmart's bigger than that, Costco's bigger than that, but really you think of the traditional grocers, these are the two biggest ones. Taking some comments from Winsight Grocery Business, which is a publication I think really does a good job of describing what's happening in the grocery industry. In a Zoom hearing on Friday, Judge Ken Schubert of King County Superior Court denied the request to stop this large dividend payment, and so ruled to extend, though, the restraining order for another 10 days. So basically, Albertsons is trying to pay this $4 billion dividend, which would represent $6.85 a share. Let's call it 36% of the market cap. And really, the sort of battle is over whether this is going to hurt Albertsons in such a way that the timing of this is suspect. Have a stock chart on Albertsons, which has really shown a lot of volatility, over the past, couple of years. I guess that's a little bit over almost a 2-year chart going back to the beginning of 2021. But really interesting that recently the stock has come down as a result of that, pending merger. It was up earlier in the year when it was announced that the company was undergoing strategic review. But so those shareholders interested to see, what's happening with their dividends, sort of where's my money type of situation. The argument that a lot of these government officials are making, which it's not just Washington State, now it's expanded to D.C., California, Illinois, that paying this huge dividend is going to hurt Albertsons' financial position, and then there would be no choice but for Kroger to acquire Albertsons in order for Albertsons to be a going concern. I think the counter argument is that Albertsons still has lots of liquidity. Even after paying that potential dividend, they'd still have $500 million of cash, $2.6 billion credit line, so call it $3.1 billion of liquidity. And people aren't going to stop buying groceries, even if there's a little bit of trading down from the traditional grocers to let's say Walmart, Costco. And so all this goes into, is this deal going to be approved? Do all of these temporary restraining orders for paying this dividend, is that sort of a precursor to what's likely to happen when antitrust judges go in and look at this deal and how many locations are ultimately going to have to be divested? When the deal was announced, Kroger said that we've already been looking at sort of which locations need to be divested, and they think it's going to be somewhere between 100 and 350 or 400 locations. A lot of those in places like the Northwest, where there's a lot of overlap, and let's say the Seattle area and the Denver area. A lot here in Dallas. I can't go very far without having both Kroger and Albertsons. So it sort of gives you a sense of is there going to be a heavy-handed regulation here in terms of allowing that deal. I think most CPGs would just like maybe this deal not to occur, because this just makes a more concentrated customer base. If you're selling into let's say a grocer that's going to be greater than a 10% customer, most of the CPGs say that Walmart is the only customer right now that's bigger than a 10% customer. Most have that at about a 20% customer, but I think Kroger, Albertsons combined is going to be greater than 10%. Some CPGs could, potentially view that as a positive if they can get into maybe the other chain, if they're only good and only strong in one chain, or can maybe leverage Kroger's data. Kroger talks about having now data on over 100 million households, which is going to be most everyone in the United States who shops at a traditional, grocer. So a lot to watch with the Kroger, Albertsons deal. So relevant, I think, to those who are not just Albertsons stockholders as to whether they are able to pay that dividend. But I'll move on to another topic on retail. This is Costco took a margin hit in fresh food. So interesting, their stock price is up on the screen there. It's been pretty volatile. It makes you wonder if anyone is really a good enough trader to sell the stock at $575 a share and buy it back at 400 or 425, and do that a bunch of different times with the volatility. And there's probably some savvy investors that are. But lately it was down a little bit because the company missed earnings a little bit. Same store sales still up 7.1%. Should mention that excludes fuel and foreign exchange, and that was on top of a 9.8% increase in same store sales from the year earlier. So still seeing a fair amount of growth there in terms of consumers spending more at those existing locations. But that 7.1% increase in same store sales this most recent quarter was the worst it's been in about 2 years, and the first time it's fallen below 9%. So I think that's what the market was reacting to, was the slowing in sales. They did say their core margins were down 31 basis points overall. Their food margins, they said, was up a little bit, but on the fresh food, the margin was down after a couple of really strong years. And they actually provided some sort of telling commentary on their analyst call. And they said that the fresh food segment is one segment that the shoppers really notice the price, because those prices are advertised in sort of weekend circulars and those things. And that's part of the strategy why they keep the rotisserie chicken at $4.99. They keep the $1.50 hot dog. That's true of a lot of these other sort of fresh foods, and they kind of view those maybe as being lost leaders, and they want they don't want consumers to not go to Costco if they view those things as being too expensive. So it seems like they're willing to take a margin hit on those fresh foods in order to keep consumers in the store. But they say otherwise, they're doing well in food, seeing some margin improvement there, doing well in things like sun dries. Maybe the exception that where they're not doing as well is sort of the areas where you would expect those higher ticket discretionary items, things like electronics, furniture. Those are under a lot of pressure. Also, Costco did say that, sort of similar to what we've heard from Walmart, where Walmart said more consumers that make over $100,000 a year going into their stores for groceries as a way to cut costs. Costco said they're seeing, the same thing. Didn't really describe it in exactly that same way, but said their average income of their consumers is going higher. Still say they're benefiting from gasoline prices, even though gasoline prices are now a little bit less than they were a year ago. They think the gasoline prices being high for that extended period of time really changed consumers' behavior and habits to buy their gas at Costco, go in and buy other things. So sort of on balance, Costco, I think, is becoming a bigger player in the grocery industry that can have implications for CPGs. The next topic here I'll talk about is FreightWaves Research Group. So those are the guys, Tony Mulvey, Michael Rudolph, et cetera, just published a 23-page research report. Have that they called asking Rocky Road on the way in 2023. So I don't know if someone had a hankering for ice cream when they wrote that title. And they do sort of answer that. I think it has a question mark there, but I think sort of flipping through the report, they seem to think that there is going to be some challenges next year. A lot of that is due to continued pressure on the consumer. And this is an interesting chart that stood out from the research report. So this is the biggest challenges for shippers as they move into 2023. So this could include CPG companies or other shippers, and it's really service. You see that bar at the bottom, meeting the service levels with customers, and that's not just the railroads, where we hear a lot about service levels there. I think it's truck. Also we've heard that from a number of CPGs like General Mills has said, well, don't know when the truck is going to show up, if it's going to have the right quantity, all of those things. So I think that's really sort of top of mind for most shippers. Even above that next one, which is from the second from the bottom, staying within transportation budget, that's still a concern. I think maybe that's a little bit less of a concern given all that we've seen in the truckload market, getting weaker, and some of those other items on that list, telling also sort of securing ocean capacity. That's the least of their concerns out of those things on the list. So the ocean capacity, there had been a lot of rollovers from one vessel to another, and that seems to have gone away. Port congestion seems to be a little bit lower concern than it had been. Even inventory levels, you might have thought that was a little bit higher. And with inventory is sort of a tale of two cities here. Are you talking about inventories that are general merchandise, which there's too much of that type of inventory, or are you talking about inventories of ingredients, food products, et cetera? Those are a lot lower. So I thought that was a good, graphic based on a survey that we did of shippers. Also have an interesting survey on carriers that I'd like to bring up, and we ask that. We ask carriers, are they going to continue to add capacity to their fleets in 2023? So in that research report, we talk a lot about the demand for transportation services. That would be a lot of consumer spending, retail growth, manufacturing, capital spending, all those things. On the supply side, we're sort of looking at this as, are the carriers adding capacity to their fleet? And this one surprised me, that this 45% are increasing the size of their fleet, from 1 to 20%. I would have guessed more would have been in that 35% range. Fleet size will remain the same, or even a decrease in the fleet size, but only 3% of carriers are saying that they're going to decrease their fleet size. About 1% are going to decrease their fleet size more than 50%. Those are the extreme bears, but it's almost like the extreme bulls that are really planning to increase their fleet size. Exceed. So the trucking companies, I think a lot of those management teams, all those executives, tend to be sort of positive by nature. I think you almost have to be if you're going to be someone that acquires these very expensive, capital-intensive, assets with the intention of keeping them turned. It's not for the faint of heart or someone that thinks the economy is about to collapse. But I was surprised by that, based on everything that we've seen in the marketplace. Potential for a decline in transportation demand. But I think maybe some fleet operators are being too optimistic, and you might see some of those carriers go out of business. So those are just a few of the highlights that are contained in this research report written by the FreightWaves research group. I just asked them, is there a way to direct the Stockout listeners to find that article online? And the answer was not yet. If you want to get it from me, you can email me at mbowdendistel@freightwaves.com. Believe it is going to be on the website, on the Sonar FreightWaves blog, where we have a lot of our white papers in the coming day or two. Just had to sort of get the right form figured out, but that should be something that you should be able to find online. The last topic here, I'll talk a little bit about what I'm expecting to hear this week on the hearing in Washington, D.C. on the railroad embargoes. And for anyone that is not sort of fully up to speed on this, there's been a tremendous amount of pressure on railroad congestion over the past couple of years. I mean, really, what typically happens, the railroads, volumes go up and down with the economy, with growth or contraction in the various sectors, and the railroads historically have been able to reduce employee count either through furloughs or just job cuts when volumes come down, and then when volumes return again, they're able to hire those workers right back because they make more with the railroad than they do in the interim at their construction job or whatever they were doing. That didn't happen this year, really, for a number of reasons. One was just, I think, the railroad workers, left with a bad taste in their mouth. The precision scheduled railroading, all the cost cutting associated with that, caused them to have to do more with fewer resources. Had less time at home, more time away from home, and all those things really put a lot of pressure on the network, not having the right personnel. And one of the big points of contention has been service levels. And there's a chart on this from the Surface Transportation Board. So this is from the U.S. Surface Transportation Board. This is on the docket that they have on their website that's going to be discussed this week. And this is for Union Pacific specifically. And so the number of embargoes from 2017 through 2022 as of August. So an embargo is railroads not going to, it's basically suspending service. It's like, there's usually a train to Chicago. It's not going because of some reason. Now, historically, that reason has been weather. There's been huge snowstorm in Chicago. It's not going to enhance the network to run the trains in, or there's a hurricane, or the network in Nebraska is underwater because of a flood. That would be the typical reasons why you would have an embargo. But lately, you've had this 98% of the embargo have just been caused by congestion. If you're watching the video portion of this, you can see on that left tab, it was 98% congestion due to only 19% in 2017 when it was mostly, weather related. So that congestion, kind of a catch-all. It could be, not having enough crews, not having enough locomotives, not having locomotives in the right place, not having the passing sidings or the infrastructure. And so what the Surface Transportation Board, which is the organization that regulates the railroad, trying to get to this week is, what is the reason for those things? Can a company like Union Pacific get it corrected? And is the railroad just being too greedy by starving the railroad of capital and not having enough employees? That situation I described earlier when they cut workers when volumes are low. Should there be some excess employees and just in case volumes recover a little bit faster than expected? I mean, really, in order for a railroad to run smoothly, given how volatile the volumes are, and given how many sort of unique events the railroad has to deal with weather and so forth, there really should be sort of some extra resources in a place there. So the Surface Transportation Board wants to understand that, and they also want to understand how the railroads come to a decision to impose an embargo, and really sort of why have those embargoes increased as much as they have. And so they're calling on not just Union Pacific. Union Pacific is going to have a panel of 5 executives present and likely really get grilled by Marty Oberman, who's the chairman of the U.S. Surface Transportation Board. They're also talking to shippers that you would imagine that really are kind of use the railroad as their primary method for transporting their goods. That would be companies in the agriculture industry, fertilizer, chemicals, metals, minerals, those things, sort of big, bulky commodities. And then in addition, there are going to be a number of panels with labor representation. A number of the unions are sending, representation on, to sort of corroborate or not the railroad's claim that the reason there were so many embargoes is they didn't have the personnel. And Surface Transportation Board wants to hear it from the labor perspective. So I think there's going to be a lot of good content on our site, FreightWaves.com, coming out of that hearing, that 2-day hearing. I believe our railroad writer, Joanna Marsh, listens to that entire thing. You may have it be written up by John Kingston as well. John's been following those issues closely. He went to the Rail Trends Conference and wrote about a lot of those issues. So that's something to keep in mind for later this week. Would keep following the FreightWaves.com to see what else is there. I think ultimately the Surface Transportation Board is going to be heavier handed, if I had to guess, in terms of making sure that the railroads are providing good service. This year they took the unusual step of ordering Union Pacific to expedite certain rail carloads, and those carloads were of animal feed that went to the animal processors, and the shippers made a big deal of this. Probably rightly so. They said that a certain number of chickens and milk-producing cows were going to have to be euthanized if they did not get the rail service and get that feed delivered to those stockyards at a timely basis. And that's the National Feed Association is going to be one of the companies that presents in the next couple of days in Washington, D.C., among many other shipper groups. And so this is really going to be sort of one of the issues I think CPGs are going to be watching for. It impacts their supply chains at a lot of different levels. Also there's one CPG company that we talk to all the time, and they said that really, some of the things that would normally move via railroad, this is really more on the intermodal side of things, move truckload, let's say in some of these competitive lanes like Chicago to Atlanta, they were moving goods. And actually, in some cases, they had to go into terminals, pull their containers out of the intermodal terminals, move them by truck to the southeast. And so that's something that I think all parties want to avoid, and particularly those shippers that are dependent on the railroad, such as a lot of these big bulk commodity shippers. So with that, that's really what I wanted to go over today. If you're not already signed up for the Stockout newsletter, I encourage you to do that at www.freightwaves.com/the Stockout. And if anyone has any topics that you want me to talk about, feel free to get in touch with me. I'm at mbowdendistel@freightwaves.com.